In the world of finance, we often tend to forget tragedies of the past, yet, valuable lessons are to be learned by analyzing the issues, their causes, and effects. Let us present you a 10 minutes analysis of the 1990s Japanese financial crisis. One reason for choosing this topic of consideration was that because it demonstrates the considerable cost associated with such a crisis and it highlights how the impact goes beyond financial markets and affect economies at large. Moreover, it serves as a warning that crises can befall a robust and relatively sophisticated financial system. For almost 20 years, between 1974 and 1995, the Japanese economy grew by 9% annually. In 3 decades, Japan went from being a war torn country to becoming an industrial and financial powerhouse. And it was also one of the most significant international creditor. Unemployment was almost non existent, and personal savings were at an all time high. It was estimated that the Japanese economy would outgrow the US economy. This phenomenal growth was known as the Japanese economic miracle. But how did this Japanese miracle give way to decades of economic crisis and stagnation, now referred to as the lost decades? Japan's macroeconomic environment in the second half of 1980 was associated with economic growth and zero inflation. These conditions fueled credit expansion and boosted asset prices within the Japanese economy. The second half of 1980 also experienced liberalization and deregulation in three forms. Trial law was introduced in 1947 for interest rate control, and it loosened over time. In 1979, certificates of deposit CDs were exempted from trial. Maturity and denomination requirement gradually loosened during the late 1980s as well. Moreover, capital markets deregulation included the accessibility of euro yen loans to domestic borrowers, the removal of restrictions on the access to corporate bonds, and the creation of commercial paper in 1987. Furthermore, Japan allowed previously segregated institutions to perform a wide range of permissible activities. It included raising lending ceilings for different types of loans. This liberalization greatly affected banks and other financial institutions. It marked the beginning of price competition, increased exposure to riskier segments of loan portfolios, and a hike in consumer lending and real estate lending. There was a shift towards capturing more significant market share, hence, negligence in credit standards and cash flow analysis. In 1989, Japan started raising its interest rates. In April 1990, the Ministry of Finance issued guidelines limiting total bank lending to real estate. This move led to a decline in bank assets from 508 trillion yen to 495 trillion yen. Finally, in 1992, land prices started to fall. The economic downturn and stock market collapse weakened the financial institution health, especially affecting the banks. As a result of the steps discussed previously, finally, in 1992, the land prices fell. Japan was headed for an economic downturn, and stock markets were headed towards a collapse. Another pertinent cause of the crisis were the banking regulations. Banks were allowed to set tax-deductible journal account to account for all possible future losses. Bank had the option to establish these accounts to determine average loan loss or set it as a reference level for tax authorities. In 1989, the reference level was fixed at 0.3% of total outstanding loans. Surprisingly, the banks would not increase their available reserves even though the non performing loans were above 0.3%. The rise in all these non performing loans was due to heavy borrowing by corporate sector of Japan in order to report higher profits using the Japanese financial engineering mechanism referred to as ZITEC. It could all be due to the following reason. First of all, banks did not want to transfer their Tier 1 capital to Tier 2 capital accounts. Moreover, banks felt raising the reserves would send a negative signal in the market. And another reason was that individual banks would not want to lend to draw attention to themselves. Hence, banks showed laxity in writing off loans because it sent a negative signal in the market, and the tax guidelines were stringent as is. Another major contributor to the economic crisis was the forbearance and restructuring that took place. Main banks were a vital feature of Japanese financial system. The main bank acted as a borrowing bank's monitor and mediator when there was doubt about the borrower's financial health. The main bank were responsible for identifying potentially insolvent banks and assisting with restructuring and mediating between the lender and the borrowers. A significant problem in the system was that the ex employees of main banks were appointed as executives by borrowers to facilitate the communication between the two entities. Since their crucial role was to monitor, the main banks were reluctant for their borrowers to default on loans. It would destroy the reputation of the main banks because default meant poor monitoring. Secondly, the main banks had to absorb some of the losses incurred by other banks. It led for main banks to practice forbearance even if it was not the viable option for these banks. The borrower banks also manipulated their balance sheets. This manipulation took place to avoid consolidation requirements. Banks had set up related companies that were neither subsidiaries nor affiliates to which they transferred their non performing loans above market value. Banks jointly owned these companies, meaning that they had interlocking shares. Another prime contributor to the crisis were the eroding margins and high risk strategies. Due to regulations, banks expanded their euro yen loans to broader borrower base to compete with commercial paper and corporate bonds. Banks started expand offerings to medium and small enterprises to protect their margins. Banks began taking more and more risk. The increased risk can be attributed to three main reasons: a shift from short term working capital finance to long term financing. It meant lengthening no maturity, exposing banks to more interest rate risk. Moreover, the restructuring of non performing loans. The banks relaxed their credit conditions to boost short term profits. It was evident by shifting loans on bills to overdraft loans. Another major contributing factor towards the crisis was the conflict of interest in corporate governance. A typical Japanese bank has four significant shareholders. Life insurance companies are the largest institutional investors. Corporate borrowers and bank established a cross shareholding system to develop long term commitment and business relationships. Bank employees are another group of shareholders as they acquire shares through employee stock participation plans. Lastly, other banks develop a cross shareholding system to expand their business base and fend off financial players. This leads to an ineffective corporate governance model since it has modest control over the management of the banks. Life insurance companies have limited decision making authority because of the limitations of their corporate governance. Corporate borrowers and banks have interdependency, making it possible for corporate borrowers to influence decisions because banks are primarily their funding sources. For employees to choose either side or against management is self explanatory. Employees, being part of the bank, tend to back management decisions. Bank, as shareholders of other banks, realize that they operate in the same financial system and hence did not exercise their corporate role. So, overall, this type of ownership structure meant silent partners. Finally, the regulatory loopholes added fuel to Japan's economic fire. Till 1997, the government's strategy for dealing with financial crisis was to postpone dealing with the problems. Between 1990 to 1995, the government did little to address the growing problems. In 1995, the situation worsened, and it was clear that a financial crisis was inevitable. Nevertheless, the government did nothing and exercised forbearance. As an overall delayed response to the financial crisis, the authorities only intended to intervene when banks became insolvent. Banks were allowed to pay dividends despite the need to strengthen the capital base and help provide for non performing loans through retained earnings. In 1997, after the bank lost 9 trillion yen, the dividends paid out were 680 billion. In 1995, banks lost almost 5 trillion yen after provisioning for 23 trillion of non-performing loans. In 1996, banks reported a small profit by reducing their provisions by half. Later in 1997, these provisions were again increased. It was done to avoid delisting from stock exchange. The rules on the loan classification were substandard and poor compared to the international best practices. After the standards were made stringent in 1998, non performing loans were raised by 50%. The lessons learned from the Japanese banking crisis experience enable us to understand the consequences of our decision making. Whatever reasons were discussed resulted the governments failing to address the banking sector problems in a timely and decisive manner in the 1980s. Causal links work both ways. A financial crisis harms the real economy, and a worsening real economy can lead to the creation of new non performing loans and depletion of banks' capital. Essentially, a deterioration in the real economy can trigger another round of financial crisis, further harming the real economy. If the authorities do not address the banking sector problem immediately, the crisis may worsen, and a full fledged economic recovery may not ever occur.